What is going on, everyone? Hope y'all are doing well, and in this video I'm going to share what I'm going to be looking for during Opendoor's upcoming earnings report and conference call. I talked about this company about a month and a half ago, and with earnings right around the corner, I think this is a good time to share what I'm going to be looking for, both the caution flags and the improvements that I want to see from this company. But I don't want to waste your time, so let's go ahead and dive right in. So for those of you that don't know, Opendoor is a digital platform for residential real estate. So they're basically the middleman when it comes to buying and selling real estate. The company allows you to find a new home, sell your current home, and make it all happen at the same time through one platform. You can schedule the tour at your own time and be able to move on your own terms. Given the world we currently live in, where there are a lot more work from home jobs, I wouldn't be surprised to see people move more often in the future, and Opendoor could be a major player in this space. But even though there are more work from home jobs, the current economy has made it more difficult to buy housing because of the increased interest rates leading to higher prices. So these earnings for the rest of the year are going to be extremely important, not only to help investors understand the housing market from a transactional perspective, but also how Opendoor has performed given this quick change in the housing market. So here are going to be some things that I will be paying close attention to for this upcoming earnings report. So the first thing that I think is important to note is the amount of homes sold has fallen. So we can assume that the transactions will be lower than last quarter for Opendoor as well. But even if we see transactions lower for Opendoor, that doesn't make it a horrible quarter. Don't get me wrong, I will still be looking at the transactions, but I think a more proper metric to look at is the real seller conversion. In Q1, they reported 35% conversion rate, and I would like to see close to the same percentage. But it is important to note that with interest rates going up, some people may not want to be buyers anymore, so this number could be lower. The question is going to come down to how many of their current homes will they be able to sell. I think that they could still buy a good amount of homes, especially with everyone trying to sell at the peak. However, if they aren't able to hold these homes and the market does move negatively, then they will not be able to make money in these next few quarters. Another thing that I will pay close attention to is the rate of sell-through, along with the number of days that a listing is on the market. These two things are extremely important, not only to understand the market as a whole, but how Opendoor is doing compared to the overall market. So when we look at sell-through, the company has continued to outperform the amount of houses that have stayed on the market for a while. Now, why is this important? Well, for Opendoor, they are buying houses that consumers want. With a high sell-through and the company focused on transaction fees, they will be able to generate solid revenue despite what the market is doing. Compared to the MLS, Opendoor has 4 times the amount of sell-through. Now we will see how this will change in a slower market, but I really want to see a good amount of sell-through compared to the rest of MLS. Given the current economy, we'll probably see more houses on the market for 120 days or more. But I believe that because of how Opendoor buys houses, they will be able to still have a good sell-through rate. This leads to the number of days that a listing is on the market and is one of the most important metrics in real estate. What I'm seeing in the current market is that many houses are making price cuts in a short amount of time, like within a week or so. The reality is that this market is rooted in the fear of people not being able to sell their homes at a profit, so they will make a price cut. But the issue is that the amount of time that homes are on the market is still much lower than the average. Plus, the amount of inventory that we have is still extremely low in comparison to the past, but I'll talk more about that later. The amount of days on the market is important for Opendoor because they are focused on transactions. So if the company can keep the percentage of their listings on the market for 120 days at about 12%, then they will be in good shape. And this leads to their revenue projections. The company expects to have between 4.1 billion and 4.3 billion. Even though this is a reduction in revenues from the past quarter, it is still over 250% growth from the midpoint. I honestly am not looking into revenues as much because they are still a high growth company, and this next metric, in my opinion, is more important because it shows how great of a company they can be down the road, and that is adjusted EBITDA. They're projected to have between 170 million and 190 million dollars. However, the interesting part is that they had about $176 million in adjusted EBITDA last quarter, but had revenues of 5.2 billion. So this means that even with lower revenues, they're still projecting to have similar earnings before taxes, depreciation, and amortization. If they're still able to get similar cash flows, then this company will be in a good shape during the recession. And this is something that people just don't understand about this company. They're not like a Zillow or a Redfin, but yet several people try to compare these other companies to Opendoor. Now, the team at Opendoor said that they are expecting the housing industry to begin experiencing a moderation in home price appreciation and transaction volumes beyond what is normal from seasonal trends. And they're expecting this to begin in the second half of this year. Now keep this in mind. This was announced in May. but I think we can agree that we are starting to see some moderation in housing prices. Now, I've been saying this for many months now, but the current housing environment is very different from the Great Recession in 2008, and here is why. First, the market inventory is still around a 40-year low going back to the early 1980s. We had 72% lower inventory available in March 2022 compared to March of 2008. Even though demand has grown because of the rise in interest rates, Opendoor says that the supply-demand dynamics will likely return to a more balanced state versus a sharp correction given today's structurally low supply. We simply have a long ways to go to get to extreme amounts of inventory to see crashes in the housing prices. The second reason is that we need to consider how much healthier consumers are today than in the past. Disposable income was also at a 40-year low and are significantly lower than what they were during the Great Recession. Something else to consider is that the financial system is in a much better spot than 2008 because of how many people were getting loans that shouldn't have been. There were people who were buying multiple homes for themselves when they had an extremely low income. And because of the current financial system, the likelihood of people forcing themselves to sell is low, like it was during the recession. But there is one example that Opendoor uses that I find to be really interesting. In 2002, the 30-year mortgage rates averaged 6.4%, and yet the number of transactions for single-family homes was 5 million. Even in a high interest rate environment, there were still a good amount of transactions. So what I believe this could be, in my opinion, is that many people got nervous because the amount of appreciation in these houses that they wanted to sell, and this increases demand. But buyers will still want to buy homes as rates begin to steady, leading to more of a plateau in prices. Now, I do believe that we will see price cuts in the markets that have had major appreciation over the last couple of years, but not every market will experience a drastic correction. The next metric that I will be paying close attention to is their contribution margins. This is really telling them how the company is going to do in a lower transaction environment. They have been around 4 to 6% in the last couple of years, and I'm looking for them to maintain those margins. Now, over the long term, they are expecting to get this metric to 7 to 9%. There are multiple things that have helped and will continue to help larger contribution margins, and they are reductions in resale costs, lower acquisition transaction costs by improving their process for inspections, and improvements in their repair and services. So I want to see them continue to have strong margins despite the probable decline in transactions quarter over quarter. And the last thing that I want to pay close attention to is how their market share is doing. In this past earnings call, they said that they have 1.9% of the market and are currently in 48 markets. Now, these two metrics are going to be really interesting to look at because it will give us a better idea if they're focusing more on growth or profitability. As I said previously, the company doesn't need to grow revenues much to generate a profit. So this could be a good reason for them to just focus on maximizing revenues to get even greater profits. But on the other hand, with several companies laying off workers, Opendoor may want to turn their attention to generating more profits. Personally, I want to see them focus on growth as long as they maintain their current profitable status. Now, with all that said, let's talk about the recent not so great news that has come out for the company. Opendoor announced that they are agreeing to pay $62 million to the FTC, or Federal Trade Commission, for tricking customers by promising that they could make more money using the company than they would on the open market. This was in reference to 2017 through 2019, so this is not something that is ongoing. However, they still have to take a hit for it. Now, the money that they will have to pay will not show up in this upcoming earnings report, but it could affect profitability in the following quarter. Now, am I concerned moving forward? Not really, because I do believe that there is evidence for them possibly providing a better deal than on the MLS, but I'll save that for another video. However, they are currently in a position where not only do they hold on to houses for a short amount of time to mitigate risk, but they are even more diversified because of how many markets that they are in. And so even if a few of these markets have drops in average home prices, there are other markets that could be appreciating at the same time to reduce any losses that occur from holding the property. But because Opendoor only holds houses on average for 3 to 4 months, they are less likely to be affected by price drops. And here is what I believe are some insane statistics to think about. Except for the great financial crisis of 2008, there have been 6 quarters with declines greater than 1% in home price appreciation. What this means is that unlike stocks, homes aren't likely to see steep falls in prices. And the worst percentage drop during the Great Recession was 3% for the quarter. Now, the question that I believe everyone needs to ask themselves is, do you think we are in another Great Recession or not? The problem problem that many people do not realize is that real estate was the major reason for the recession, and the amount of inventory was through the roof. With low amounts of inventory, it is difficult to say that the same thing will happen as '08. In every other recession besides the great financial crisis, one of the best performing assets was real estate. So using what we know, housing does not look like a place that we will see devastating price drops. Mix that with Opendoor holding homes for a short amount of time, this could actually be one of the safer real estate investments in the entire stock market. And I see this one making some huge returns in the next few years, which is why I'm buying at current share prices. But I hope you all enjoyed this video, and if you did, smash that like button. That helps more people see this kind of content as well. And if you're new here, hit that subscribe button and notification bell. That way you're notified when new content comes out. Also, add me on Instagram where I share smaller clips about investing and building wealth. Hope you all enjoy the rest of your week, and I'll see you in the next one.